Welcome to Retirement GPS, navigated by Zynergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome back to the Retirement GPS podcast. I'm your host, Ryan Zaharchek, certified financial planner and president of Zynergy Retirement Planning.
And I'm your co-host, Zane Belsack, associate planner here at Zynergy.
So we got a really special episode today. This is an ad hoc episode we decided to do because we've been getting a lot of questions lately about what's going on in the world, what's going on with the markets, what's going on with the economy as a whole. So we decided to do an ad hoc retirement questions answered. What are your questions about what's going on in the world today, specifically related to things like the attack on Iran that Israel and the United States has recently implemented, also how that affects the market, both stock market and bond market, and of course how it affects things like oil and your prices at the gas pump and the components that are related to the trickle-down and knock-on effects, this military action, this war that has been started. So we do want to touch on it because we know that's concerning, so we're going to bring it up and try to lay those concerns.
I think every single person listening now is wondering, why are my gas prices so high and why are the price of goods so high?
Yeah, absolutely. And it's been a problem. It's been a problem for a lot of years, right? Pretty much since COVID, where prices have been soaring and we haven't been able to get them under control. And this is not a positive sign that gas prices are moving in the right direction. Let's start at a very high level. Let's start talking about what's going on and what are the trickle-down effects of what's going on. It wasn't long ago, at the time of this podcast, it was around a month ago, that the U.S. and Israel coordinated on a military attack of Iran in an attempt to stop Iran from continuing to enrich uranium, to pursue nuclear weapons, and just keep them in check. And whatever your politics are, this is not a political podcast, so we're not going to get into the details of whether you agree or disagree with what they're doing, but that obviously that military action is creating a problem specifically with one of the largest commodities in the world, and that's oil. So the price of oil, as soon as that military action occurred, spiked dramatically. It was trading around the mid-60s before that military action, and currently is over $100 a barrel. And as Zane mentioned, over $100 a barrel trickles down to what we pay at the gas pump.
It's not fun.
No,
Not fun indeed.
Now, for sure, when you pull out your wallet and you say, how much was that tank of gas? And we just got word over the weekend that oil now topped over $4 a gallon nationwide. And of course, for our retirees and for the people listening to this podcast, oil is something that affects all of us, right? It affects what we pay at the pump. It affects what we pay at the food store because, of course, trucks use diesel and fuel to get that food to the grocery store. And it affects the cost of jet fuel. A barrel of oil is broken down into several things that we purchase pretty much on a daily basis, or it affects the things that we pay for on a daily basis. Really, those are the events that are leading to those high oil prices. And then, of course, the trickle down to consumer prices. Now, the question that typically comes up and the big concern is that will cause inflation, correct? Inflation is the persistent increased prices of goods and services over time. So, yes, the concern is that this inflation going to be entrenched? Is it going to be permanent? And really, historically, that has not been the case. It doesn't mean it won't be the case in this circumstance, and it doesn't mean it hasn't been the case in the past, but rarely has it been the case. Typically, when oil prices spike and oil prices go higher, it is more as a tax on the economy as opposed to an increase, a persistent increase of goods and services. And what does that mean? It means that when oil prices go, let's say to fill up your tank with gas, it used to cost you $40 to fill the entire tank, and now it's costing you $60, right? A pretty dramatic increase. That increase is going to theoretically create this shock in prices that is higher and is going to cause you to reflect on potentially changing your habits. But it's just going to be a tax. It's going to sap the discretionary money that you have for other things, but it's not going to create a persistent increase because theoretically oil at $100 a barrel today is not going to be 110 next year and then 120 the following year. That's what would have to happen for inflation to become entrenched and to stay up over time. And I know that sounds crazy because everybody says oil trickles down to everything, to consumer prices for food and for goods, to get those goods to the stores. And again, yes, it does, but it's typically a one-time effect. And that's what Jerome Powell talked about yesterday when he was at Harvard. As of the recording of this on March 31st, Jerome Powell had a talk at Harvard University. He talked about the oil shocks and typically how that affects inflation. And he said it does have a limiting effect on inflation or a temporary effect on inflation. So not that he's not concerned about it, he's not watching it, but that's the expectation by the Fed, is that it is a more of a shock than an actual ongoing persistent inflation.
So really the prices of oil are just up because of this overall conflict, not really because of inflation per se.
Correct. And that's the point. Inflation tends to come from a money supply, which, as you can see what happened during COVID, it's the continual printing of money that inflates the value of every good and service. With an oil shock, that tends necessarily not to be the case. So we'll see how that all plays out. But the hope here is that this conflict will resolve itself in relatively short order and that oil prices stabilize and start to potentially come back down. What we do find and what we have seen, if you remember in 2006, 2007 through 2008, during actually the financial crisis, oil prices had spiked pretty dramatically. And then what happened is the way humans adapt to high oil prices is they start to focus on things that are oil related. So they want more efficient cars. EVs start to sell a lot more when oil prices are high. They want more efficient insulation in their homes. So they'll buy windows that are far more efficient or appliances that are far more efficient. They start to put solar on because they don't want to pay for oil heating anymore because oil prices are so high. And this efficiency, even though it'll start slow, it starts to gain momentum. And this efficiency, by definition, then starts to bring down oil prices because the demand for oil becomes less and less when prices are high. So it's like the old adage that the cure for high prices is high prices, and the cure for low prices is low prices. So that's really what we would expect, especially if oil stays high for a protracted period of time.
That does make sense. If oil keeps staying up this high, I might need a pay raise, Ryan. I can't keep paying for my gas at this price.
Yeah, if this is your on-air way to ask for a raise, Zane, I think we'll talk about that offline. But it's true that's where the concern with inflation does come. Is that's going to then start to trickle down to employers needing to pay their employees more and so on and so forth. We'll see how that plays out, but the expectation is it's more of a shock than an actual ongoing inflation. But that does affect bonds because if you've seen the 10-year Treasury, which affects a lot of things like home mortgage rates and savings rates and things like that, the 10-year Treasury spiked dramatically over the last 4 weeks after this attack on Iran. And we went from about a 4% 10-year Treasury yield to about 4.4%, which is a pretty dramatic spike, about a 10% spike in a short period of time, which is very volatile for bonds. And the reason is that there is very little chance right now that the Fed's going to be cutting rates, which was the expectation for the rest of the year. A continuing rate cut, inflationary decline. We were seeing inflation decline, even though it was a little bit stubborn. It was declining gradually. We're not seeing that now, and the expectation is we're not going to see that now purely because of oil prices. So typically during market volatility, during geopolitical strife, people fly to these safe havens such as U.S. Treasury bonds. They're not doing that now, and they're not doing that now because there is an inflation concern tied to that as well. That is affecting bonds. So if you have a bond portfolio as part of your overall portfolio, it's not doing a lot to help your portfolio right now, which is problematic.
Now, a question that I'm thinking of, and I'm sure a lot of listeners are also thinking this, but what exactly does this bond increase mean for my investments, specifically Zinergy type investments?
Sure, yeah, that's a great question. A good portion of our retirees' portfolios are in bonds, and we use bond funds just because we don't want to have individual bonds. So we have groups of bonds in a bond ETF. So if you have a 60-40 portfolio, which is a standard retiree type portfolio, 60% stocks and 40% bonds, typically what happens is, and we've done an episode on this in the past, but as interest rates rise, bond prices fall. And think about it this way. If I had bought a bond a year ago that was paying 4%, right? And I'm going to hold that bond for 10 years. I'm going to get 4% for 10 years. What happens if current rates on current bonds rise to 4.25%, then 4.5%, then 5%? My 4% bonds look less and less valuable today than they did a year ago. And the opposite's also true. If bond rates fall to 3.5% or 3%, my 4% bond looks like a superstar. And in which case the price is going to go up because there's going to be higher demand for it if I sell it on the open market. So there's an inverse relationship between yields and bonds. As yields go up, interest rates go up, bonds will drop in price. And that's pretty much how that works. So we want to have bonds in our portfolio because typically if the market's falling, interest rates are also falling because the Fed is lowering rates. Inflation is well under control. You don't really have a lot of inflation in a falling market, with rare exception, 22 being the biggest exception in modern history. And the bonds and stocks tend to offset each other. That really hasn't happened much in the last month. In a very short-term basis, that's what sometimes happens. They have a high correlation, but typically they have a negative correlation. Let's bring it full circle and talk about the stock market, because that's really what is concerning most people, I think, in this environment. Is we have, call it for lack of a better word, a war with Iran. We have high oil prices, which could lead to inflation. We have spiking bond yields that are making mortgage interest rates much higher and certainly creating a problem for inflation on that sense. And now the stock market's falling. I mean, we just hit correction territory on the Dow, the NASDAQ. I think the S&P 500 is right there. And let's define that. What is a market correction? We did an episode on this a few episodes ago on market drops. We talked about a 20% pullback. Market correction is defined as a 10% pullback. We call it a drawdown in the stock market. And a drawdown is just an overriding, hey, the market's falling. We call that a drawdown. Now, a correction typically means 10%, all right, in the investment world. If the market falls 10% or more, we are in correction territory. If it falls 20% or more, we are in bear market territory. Those are really the two terminologies that we tend to use. And we just hit that. We hit that pullback of 10%. We now are in correction territory in two of the three indexes, with the S&P 500 on the cusp. And we just want to be clear, not every correction, not every 10% correction turns into a 20% bear market. Just because we're down 10% doesn't necessarily mean it's going to fall 20%, which means if it's down 20%, it doesn't mean it's going to fall 50%, which has happened 2 or 3 times in the past 50 years. So question is, what do I do about that? How do I think about that? And what I like to do with market pullbacks, market drawdowns, is I like to put them in context. Because historically, it's important to understand that you're going to get a 5% pullback, a 5% drawdown 3 times a year on average. All right. So if you look over the last 20 years, on average, you've had about 65% drawdowns. Right. So if a 5% pullback scares you, then you are really not cut out to invest in the stock market, because it is going to happen a lot. And you want to be able to sleep at night. So maybe just, even if you are invested, maybe you just shouldn't look at your portfolio very often, especially during times of turmoil.
It's a wise idea.
Wise idea. 10% pullbacks, which we now call a correction. So a 10% correction occurs on average once every year. So in the last 20 years, it's occurred about 20 times. So what does that mean? And it doesn't mean that you're going to get one every single year. It just, on average, that's how often they occur. Now, you got to remember how averages work. They are averaged over time, but looking at variance, you may have 3 years where you don't get any market corrections, and then you may have 1 year where you get 2 or 3 market corrections. Just in general, that's where we average once a year. They do happen regularly, and they are just a part of investing. Once again, you have to be prepared and understand that I'm going to get those on average once a year. That's where we are. We had a 20% pullback, an actual bear market pullback, last year in April, after tariffs were announced by the United States to the world. And that created a 20% pullback in about a 6-week period. And then we rallied right back from that. So we hit our 5%, we hit our 10%, we hit our 20% all at once. Now a 20%, which we're now calling a bear market, a 20% bear market, 20% drawdown in the stock market, occurs once every 3 years on average. So if we're going to get, in every 3-year period, if we're going to get roughly 9 5% corrections, 3 10% corrections, and 1 20% correction, it means logically every 5% pullback is not going to turn into a 10% correction. Every 10% correction is not going to turn into a 20% bear market. What does the current correction turn into? I don't know. We could be down 10% and then start to rally from here. We could be down 10%, turns into 20%, and that's the bottom, and that's where we then start to rally. Or we could go from 10% down 50% and then have a protracted secular bear market and then start to rally after a year or so. The point is, we just don't know the future. We don't know what's going to happen, but these pullbacks are a part of investing and really nothing to be too worked up about. Certainly shouldn't be doing a lot to change your strategy once you have your financial plan in place.
Now, this is a pretty funny way that I think about it, but a bear market versus a bull market, I learned this a while ago, but a bear, you think of the way that they attack, and a bear always, you can't see because we're on a podcast, but a bear scratches down, and then a bull raises its horn. So you can remember that a bear is down, a bull is up.
Yeah. Yeah, and if you have trouble remembering it, that's a great way to remember it for sure. Doing this long enough, it just comes
it kind of clicks with you. Yeah.
Naturally to me.
It's just, I remember learning about that when I was a really young kid, and that's just ever since then, that's the way that I've remembered it.
Yeah. So the question now comes, with all this turmoil going on in the world and all these violent moves, both in the stock market, the bond market, the oil market, the commodities market, what do we do? What are our next steps here? And there are really a few things that will make a difference in your long-term investing, in your long-term strategy. The first one is take a breath and relax. We try to put these corrections in context. We try to put these drawdowns in context because we want people to know that they are common, they do occur. You are not just unlucky, wrong place, wrong time. Like, everybody experiences these. If you're investing for 30 years, think about how many 20% bear markets you're going to go through. And the answer is about 10 in 30 years. Boy, if you can't deal with a 5% or 10% pullback, 20% is going to feel really painful. So understand they're just a part of investing. So take a deep breath, relax. But you say to yourself, there must be something I can do. There must be something I can do to help my situation. And the answer is yes, but probably not what you think. Most people think I should get conservative. I should sell my stocks. I should do this or I should do that. These over-the-top type of way of making radical changes. And the answer is no. You really need to stay the course to your plan. Whatever your plan was a year ago or 6 months ago, it should still be that today, unless something else changed in your life, right? Unless you've had a health issue or there's been a big expense come up that you wasn't planned for. But staying the course is really what you need to do. And if you feel really strongly that you want to do something to help your future, there are two things you can do that, my opinion, will dramatically supercharge your future. Number one, if you have a little extra cash sitting around, meaning if you had a larger cash cushion than you expected, maybe you got a big tax return that you didn't expect, now is a great time to actually put that to work, because we got this 10% correction. And if we do get back to new highs this year, off the bat, you've got a 10% return while the market is just getting back to break even. So now is a good time to invest for sure. And then the other thing is rebalance. Rebalance is always an important part of investing, and it really can be very helpful during this time. So if you're a 60-40 portfolio and your stocks are down, now currently stocks and bonds are both down, but it may make sense. Bonds are definitely not down as much as stocks. It may make sense at this point to just run a rebalance. Even if you've only drifted a few percentage points away from your target, meaning you're now 56% stocks and 44% bonds, just run a rebalance. Buy more stocks while they're cheap. And you can continue to run that rebalance every time you feel a little bit of angst, every time you feel like things are out of your control and you don't like seeing your balance in your portfolio, just go in and run a rebalance. It's the way to really bring yourself back to where you need to be ready to go so that when the market does recover, you're there to take advantage of it.
Hey, that's why it's great to have a financial advisor. Take all that angst for you so you can turn off the news and take a walk.
Absolutely, yeah. It's then something you don't have to worry about, because guess what? We're rebalancing for you. And we are. During a correction like this, even if we haven't drifted always fully away from our percentages, we are running rebalances. It's something that we think about on a regular basis. Thanks for joining us today. Keep learning, keep planning.
Thank you for listening to Retirement GPS, navigated by Zenergy. To explore today's topic further, visit our blog mile markers at zenergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zenergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zenergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.